Hey, what's up, my friend? So in today's episode, I want to share with you five trading myths that has fooled almost all new traders. So myth number one, right? You will probably hear something like this. Oh, if you just trade one standard lot and you make 20 pips a day, right? You can make a full-time income from trading, right? That's about $4,000 a month, right? Just need to make 20 pips a day, right? Euro dollar, it moves an average of 100 pips, right? Can't you just, take 20 pips out of the market? All you need is 20 pips, one lot, and that's 4 grand a month in the bank. Now, what's the problem with that statement, with that idea being presented to you? I'll tell you what it is. So yes, on average, right, most currency pairs, they move more than 20 pips a day, right? Some maybe 80, 100, 150 pips, depending on the volatility of the market. And it might seem plausible, right, if a market moves like, 100 pips a day. All I'm asking is 20 pips, right? If I make 20 pips on a one standard lot, that's about $200 a day. Multiply it by 5 trading days a week, that's $1,000. 4 weeks in a month, that's about $4,000. But the problem with that statement is assuming the market doesn't change. Assuming that your trading strategy will continue working. But here's the thing. When have you looked at a chart and the chart is always in an uptrend? When have you looked at a chart and the chart is always in a downtrend? When have you looked at a market that is always in a range? One thing that you can agree on is that the market is always changing. And for you to make profit every single day, for you to make 20 pips every day, for you to make money every day, is assuming that the market doesn't change. And that's how your trading strategy can make money consistently every day, 20 pips every day. Is that realistic? The answer is no. Market always change. And when markets change, your trading strategy stops working. And that's where you have to adapt to different market conditions. And how fast you adapt, right, will determine, right, how deep of a drawdown that you go. If you adapt slowly, then clearly, right, you will suffer a deeper drawdown. If you adapt quickly, then your drawdown will be much shallower. Make sense? So don't fall for this, just make 20 pips a day, one lot, you can make a full-time income from trading. That's bullshit. Okay? Number two. This is a very common one. The market trends 30% of the time. You probably heard that as well, right? Oh, the market is trending 30% of the time, right? It's in a range more than half the time. So I was actually, I thought that was actually true. I bought into this as well until I did my own test, right? Again, this was a test, an idea that I learned from Andre Unger. He's a World Cup trading champion. He said that different markets have different characteristics. Some trend better, and some have a mean reverting behavior. So one very simple test that you can do is, again, it's his idea. He said that every time the market breaks out of the previous day high, you buy one lot. And when it hits the previous day low, you sell that long position and you go short. And if you do this, right, for any market, okay, for any currency pair, right, you would have a sample size of data. You would know, right, whether the market has a trending behavior or a mean reverting behavior. Because by doing this simple test, this simple back test, and if your equity curve is sloping up higher over time, it's telling you that this market has momentum, it has follow through. Whenever it breaks above the previous day high, it has follow through. It continues to go higher. Whenever it breaks the previous day low, it has followed through, it continues to go lower. And if that's the case, right, for that market, you will have an upward sloping equity curve. On the other hand, if you have a market that has a mean reverting behavior, every time it breaks above the previous day high, it has no follow through, it just reverses back lower. Or whenever it breaks below the previous day low and it reverses back up higher, that is a market with a mean reverting behavior. So different markets have different behavior. Some trend better and some, simply are mean reverting in nature. So again, right, don't trust that, markets trend 30% of the time, because that's not true, right? It really depends on the type of markets that you're trading. And again, that only can be done, right, based on your research and your testing, and you have to find out for yourself. But a couple that I can share with you right now is that as of right now, pound dollar, pound yen, they are trending markets. Aussie Canadian is a mean reverting market, and this is based on the daily time frame. Third thing, right, there is a best trading strategy out there, right? The best trading strategy is the one, right, that generate the most amount of profits. Well, that's not true again, right? You can't judge a trading strategy based on the amount of profit that you make, because the amount of profit that you make is determined by a couple of things. Number one, the size of your trading account, and number two, the amount of risk that you're taking. For example, an account that has $1,000, you would expect that $1,000 account to make like what, 10,000, 100,000 within a week. On the other hand, if you have, let's say, $1 billion trading account, your P&L each day can go up 100, 200k. It's pretty normal. Okay, so don't judge a trading strategy based on the how much profit that person has made, right? Doesn't work that way. On the other hand, right, some people might judge a trading strategy based on the percentage returns. Right? Let's say 2 trading accounts, both are 10k each. One account made a 50% return, and the other account only made maybe, let's say, a 10% return. And you might think, oh, the strategy that made 50% return, that's a better trading strategy. No, that could be because of the risk management. Maybe that particular person who's trading it, he risked 50% on each trade, and he achieved a 1-to-1 risk-reward ratio. That's how he is up 50%. On the other hand, that guy could be risking 1% on each trade. He made a 1-to-10 risk-reward ratio. He made 10% on his account. So don't look at percentage, because again, percentage doesn't tell you anything. Okay? So really, the short answer is this, is that there is no best trading strategy out there. You can't really define what is the best trading strategy. Ultimately, you have to find a strategy that you're comfortable with, it resonates with you, and you can trade it consistently. That would be best for you given your circumstance. And number 4, support resistance, it gets stronger on every test, right? So if you read a lot of textbooks, you read a lot of forums or whatsoever, you see that, whenever the price tests support, right, the more times it's tested, the stronger it becomes. And that again is something that I can't agree. Because based on my trading experience, the more times support is tested within a short period of time, the weaker it becomes. Because the reason why support holds is because there is buying pressure down there. Maybe, a huge institution wanting to buy a certain amount of order at that price area. And the more time support is tested, right, that order gets thinner and thinner until it's gone. And when there's no more order left to support the price at support, what happens? Well, support breaks. It breaks down. So think of it this way, an analogy. Right? Imagine there's a door in front of you, one big wooden door. And you have a sledgehammer in your hands. And you smash the door, right? 3, 4, 5 times. Let me ask you, does the door get stronger or does it get weaker? Well, clearly that wooden door would have a hole and eventually it's going to break. And it's the same thing as support, right? The more time it's being tested within a short period of time, the greater the likelihood it will break. Not 100%, but more often than not. And finally, the last thing, number 5, you've heard traders who tell you, right, oh, it's not possible to make money in the markets, right? Trading is a gimmick, forex trading is a scam, yada yada. And the reason why they say that is because they have to justify their failures. They fail to make money from the markets, and in order not to look stupid to themselves, in order to not be, looking like an idiot to themselves, they have to justify and say that it's not possible to make money from trading. And that's their belief, right? To make them feel good about their failure. But here's the thing. One person's belief does not mean that it is the truth. And you, as a trader who's trying to make it in the markets, don't let the belief of a negative person affect you. Because that is their belief. It is not the truth. Okay? So don't let the failure of someone else justify your failure. Don't use that as a reason. If you put in the work, if you go all out, you can find success in the markets. May not be the kind of expectations like, the Lamborghinis, the hot chicks, the get-rich-quick schemes. It may not be that line of success that you might be envisioning, right? But you would have a skill that allows you to compound your returns for the rest of your life. And that to me is success. Okay, so don't fall for that myth, right, where it's not possible to make money from trading, because that is just that person's belief to justify his failure. Don't let that happen to you. So with that said, I have come towards the end of today's episode. I wish you good luck and good trading. I'll talk to you soon.